Hi, I'm Toby,
And I'm Nick.
and welcome to the Pure Property Podcast with Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you our industry insight and knowledge to help investors to invest intelligently. And this week, we're going to take a bit more of a backseat from the UK market because I feel like we've been hammering that for the past few episodes. And realistically, there isn't much changing massively in the market. And so there's not too much more to focus on at this stage. But I'm sure next week that will change as we're sort of trying to look at the landscape a bit more. So we thought we'd focus on something that we haven't done for massively a while, which is the Dubai market, because again, as you know, we have an office out in Dubai where Nick is now. It's a very strong market. There's a lot going on out in Dubai. It's an ever growing market as well. And you'll always hear bits and pieces from us about Dubai. And if you're signed up to our Dubai newsletter, you'll keep in touch with the market. But something that's very popular in Dubai and does well for investors is the guaranteed returns investment options that we and developers have to offer. So we're going to look at that. Nick will obviously take the lead on that as he's more specialized in that subject, but we'll also look at it in sort of dribs and drabs to the UK market, because we do have these similar options here in the UK. Not something that's sort of massively out on the market, but there are some options there. So we'll try and fit it in and relate it back to the UK market as well. But Nick, why don't you sort of hit things off and give us a bit of an introduction to what are guaranteed rents and what are they in the Dubai property / real estate market?
Yeah, perfect. So as you mentioned, this is very, very relevant to the UK as well. So just to set the scene, in Dubai, when we're looking at guaranteed returns, it's predominantly hotel properties and hotel investment opportunities, which we're referring to because tourist numbers and general sort of visitor flow to Dubai are some of the highest in the world. So we'll discuss that a bit later. But in the Dubai context, it's very much a focus on the hotel investment side of things for the guaranteed returns. But in the UK, as Toby mentioned, and we'll probably chat about a bit later, you still can get residential properties which might have 1, 2, 5, even very rarely up to a 10-year rental assurance or guaranteed return, however you want to word it. And then in the past, people might be familiar with concepts like care homes, hotel rooms, student accommodation, all these different sort of niche asset classes within property, all are underpinned by the principles and the advantages and disadvantages of what we're going to discuss today. So moving on then, the key concept of the podcast is going to be the advantages and the disadvantages around purchasing hotel / guaranteed return properties, mostly in Dubai. But as I say, we'll try and relate that back to the UK. So just to set the scene then, in terms of what a guaranteed return is what we're presenting is a agreement where an investor or a buyer will purchase a property, then they will have a direct agreement with the developer or the property manager to receive a certain level of income, whether that's a monthly, quarterly or yearly basis, based on their purchase price. So typically what you'll see advertised is, a 7% return, an 8% return, very rarely up to a 10% return. And what that means is if you buy a property for, let's just say pounds, £100,000, and you're getting a 10% return, the developer is guaranteeing you £10,000 per year in rental income. So it's not going to go up, it's not going to go down. That's your fixed guaranteed return, or what it's known as in the UK as an assured return. So it's legally binding. You'll have a formal document in place, but there is a couple of questions around, is this going to suit your investment strategy? Are you more tailored to other things? There's different pros and cons that you want to consider when you're looking at the aspects of guaranteed returns. So
Just on that as well, Nick, I think the first question you'll always get, and it's quite a simplistic question, but one that's commonly asked is, well, what happens if they're not making enough rent to cover it? Or that's the question I always get. What if the rents drop, or what if they rise? That's sort of a question that I always get, and I know it might seem simple, but to a lot of investors, it's quite a question. So, what would happen in that scenario?
Yeah, I mean, we'll go on to the reliance on the developer and the aspect of contingency plans, fluctuations in the returns, etc., etc. But the long and short of it is one of the key advantages is whether the property is occupied, whether it's rented, it's not going to make any difference at all. The developer is still obliged to pay your contractual return, whether that's in the UK or Dubai. So if anything happens to the developer, or they don't pay the returns, they are legally bound to pay. So there are certain implications and knock-on effects of that as well. Does that make sense in answer to your question?
Yeah, and I think another thing that I always express to people is what you have to remember is these developers are setting the returns in most cases, and I think this is where you'll come on to reliability, etc. But most cases, they're basing their returns on what they know they can deliver. Don't get me wrong, if they do better and they make a little bit on top, that's excellent for them. But you have to remember they're bearing the brunt of all the risk. But they're going to be pretty solid that they can provide those returns to you. And if it drops a little bit, obviously, if it does fluctuate, if there's void periods, they're going to be factoring this in. So, but yeah, I'm sure that's where you're coming to the point about reliability and the developer,
Yeah, I mean,
etc.
that's a great point. It's an episode in itself in terms of due diligence. How do you identify a safe guaranteed return? What contract terms do you look out for? How do you know the developer is the right one to partner with? There is a long list of things. We probably work with 50 odd point checklist when we're running due diligence on a developer. So yeah, we'll try not to get into too much of the nitty gritty today. If you do want specific advice on the risk profile of any opportunity, then do let us know. But yeah, perhaps we'll kick off with the key advantages then, or what are some of the positive reasons why someone would want to go for a guaranteed return option. So the first one I'd say would be the time and simplicity factor. So when you buy a normal property, particularly residential property, you're going to have a management company look after it for you, and then obviously they're going to rent that on the open market, and then you're going to have tenants come along. But some of the aspects that you're going to have to deal with are things like tenancy renewals, maintenance issues, deposit issues, rent rises, or in Dubai there's actually rent controls, how they're looking after the property, eviction issues, and all a host of wild stuff that you might come across. Whereas if you buy a property with a guaranteed return, this is largely redundant because the developer, whatever happens, they're going to pay you that certain amount of money. So even in a residential scenario, yes, you're going to have a property manager look after it for you. However, you're still going to be told or advised or asked even about your thoughts on certain scenarios. Do you want to get this boiler? Do you want to get that boiler? Do you want to use this contractor? They're going to cost this much. Is that okay? Can you approve this? So you have all the headaches that come with managing normal residential property. Yet if you go for a guaranteed return option, you don't have that. You simply don't have it. They do all the management behind the scenes, and then they simply pay you your fixed return. But I don't know if you've got any examples of where tenants have caused issues in the past, Toby, or any horror stories that you've heard of.
Yeah, I know of landlords that have sold recently and put their properties on the market where they have had nightmare tenants, and they've had to deal with it themselves. It's left their property in a bit of a state. The other thing which can sometimes be an issue is void periods as well.
Yeah.
So again, like you said, time and simplicity. That's been something which it takes up time when you're having tenants leave and then come back in, etc. But yeah, in terms of simplistic wise, that the sort of the assured rents like we get here in the UK, whether that's 1, 2, or 3 years, is well, it's music to landlords' ears, especially landlords that want to be completely hands off. Because even when you have got a managing agent involved, you have to remember if you've got a 12-month turnaround of tenants, that's every sort of in between that period, you're going to be having maybe sort of phone calls every once in a while. Maybe if the tenant needs a bit of assistance with something, the managing agent will still contact you. But also at 12 months, if the tenant leaves and you have to sort of switch over tenants, then you have to start the whole process again of finding a new tenant. You're then going to be paying sort of new tenant fees, sort of when they go in, sort of for your managing agency, the contracts, whatever agreements you got with them. So the stuff like this, which you don't think about, and having that sort of peace of mind for a period of time is always good. And it also gives you a chance to get a track record going within that property. So if you've got a 3-year, 4-year, 5-year assurance, during that 4 or 5 years, you've got peace of mind, less headaches. And when you come out of that 5-year period, you can then look back at your portfolio and say, right, actually, Mr. Letting Agent or developer, whoever I'm dealing with, what's it been running at? What's the current rents running at? What's the turnaround looking at? Okay, brilliant. So for 5 years, I've had that amount of rent. I know the rent's at this now. Tenants are turning around about this rate. Do I keep it? Do I get rid of it? Or you can then start forecasting going forward as well a lot easier. So that is sort of simplistic to a landlord and an investor, especially if you're very hands off.
Yeah, perfect. So that covers off the first point in terms of time and simplicity. And then that certainty aspect that Tobi's mentioning there is a big one. That's the exact phrase I would use as well, peace of mind. When you're going into a property investment, it can be very, very daunting, especially if you're going overseas and, you might be investing, even if you're in the UK and you're based in London, you might be investing in the Northwest, Liverpool, Manchester, etc. So having that certainty and that peace of mind to know you've got that contractual return, even if it's 1 year post completion, that can be really, really reassuring for some people. And as Tobi said, you could turn around at the end of the year and go, right, what's been the real data and the real performance of this property? What are the rental values that have been achieved? And then you can base your future rental prices, and you'll just be a lot more well informed and well versed in the local marketplace at that stage. So yeah, time and simplicity, and then of course that certainty aspect, I would say are very, very big ones. Cool. Now, looking at the figures then and the actual return, or what's the numbers driving this type of investment, one of the key benefits is the fact that what we would call in the UK the rental yield, or what people call over here is the ROI, the return on investment. So effectively, that's just the percentage return that you're going to receive based on the purchase price. Now, the rental income and the cash flow from hotel or guaranteed return properties typically tends to be slightly higher than what you would achieve on the open market, obviously because they're trying to incentivize buyers in most cases. So a big advantage is that you will get typically a point or two above on that guaranteed return in comparison to the open market. So it's really beneficial in the sense that if that's what you're looking for, if that's your strategy, Tobi bangs on about this all the time, know your strategy, know what sort of properties that you're going for, how much money you need, what's the growth going to be in the long term. But if your strategy is very much, an income generator, or something that's going to top up your pension, or something that's just going to get you consistent cash flow month in, month out, that's great. You can look at, guaranteed returns and hotel properties. So the only downside is that obviously your capital growth is not typically always as high on hotel investments or commercial assets, but we will touch a bit more about on that later. But in terms of the rental yield, if we relate this back to the UK market, then Tobi, what sort of, both on the guaranteed return options and then the normal rental management options, what sort of returns do you think people can be expecting, maybe in the north of the country versus the south of the country, or something like that?
Yeah, I think if you're looking at rental assurance, you will probably be looking on average between 6 to 7% net. Anything higher than that, I would be quite dubious about how they're achieving those figures. So that's what you'd be looking for if you're looking at a rental guarantee / assurance. Generally, if you're going to go to managing a letting agency, that probably drop down to about 4, max 6% net, depending the type of property you got on sort of operation that you are looking at, is probably what I would say on that front.
Perfect. Yeah. And then that would be, the city centre stock, right? So probably new build city centre. That's typically where we most commonly see those guaranteed returns as well. So there's some figures that people can keep in mind, and that would be on the residential side as well. We do occasionally, as a company, Track Capital will have, student property that will come to market. What sort of price ranges do they come in at typically?
You're probably looking, so they'll start from about 60,000 up to 100, 120,000, depending on the location, the type of unit, and the rental assurance on there will be probably anywhere from 7 to 9% net. they will be slightly higher, and that's not just because they're incentivizing investors. That's because student accommodation properties will yield higher, because you're paying less, but the rents are still at a premium because students pay that, especially for the locations and the types of developments that we're dealing with. So that's what I'd be anticipating if you've got the rental insurance. And most new stock of student investment properties will have a rental assurance there. So that's always sort of good to bear in mind if you are looking for a nice high yielding investment with a rental assurance, and you've got the cash funds to deploy, and it will fit your strategy. Then definitely consider purpose-built student accommodation, because even after the rental assurance period, you'll tend to find the yields will still be higher. Capital growth isn't as strong as normal residential, so you do have to bear that in mind. But if you are looking for a higher yielding asset, then that's the one that you should be looking at potentially.
Yeah, that's a great point, and how you can compare the UK to Dubai. I'd say if you're buying in Dubai and you're looking for a real income generating secure asset, it has to be hotel investments. That's just suited to the market here. The education, in terms of the amount of universities and the sheer student numbers, is significantly lower here to the UK. So if I was advising someone, comparing UK to Dubai for fixed return and guaranteed returns, to say if you're buying in Dubai, go with a hotel. If you're buying in the UK, go with student accommodation, because it's a very mature student market. Purpose-built student accommodation is a very well-known model now in the UK, so it can be absolutely perfect. And as Toby mentioned, you're going to get that slightly higher rental yield, slightly longer rental yield, and then after post-rental assurance, you can expect a strong rental return as well. So we don't, these days, we're very residential focused. We do occasionally have student accommodation development. So that's something you are interested in discussing with a member of the team, just get in touch and we can help you with that. But yeah, the only word of warning or disclaimer I will give, and I'll probably give Toby some nightmare memories here, is things like care homes, hotel investments in the UK. It's a bit of a grey area. There are a lot more complex investment structures. We saw, a couple of years ago, the FCA started to get involved. Google restricted some advertising of some of these products as well. So do steer carefully. I mean, in general, we're quite confident in residential and student accommodation for fixed returns, but at this, care homes and hotel investments in the UK, just to be careful with that, and maybe run those by us if you do see anything. So cool. Moving on then. So just to recap so far, looking at the guaranteed returns, we've spoken about the time and simplicity, e.g., it's hands off, it's fully managed. We've spoken about the certainty and consistency that you can get from that income and having that guaranteed return. We've talked about the rental yield level. What can you expect in terms of percentage return? Just to relate that back very quickly to the Dubai market, to give you an idea, hotel investments here, you're typically kicking off around the 7% mark as a net return. And that can be fixed for up to a 10-year period. And our highest that I know of in the market at the moment is an 8.33% net return, which is contractually guaranteed for a 12-year period. So you put down your capital at the start. For 12 years, you're going to have the same amount of money coming into month in, month out. So really, really can be a good cash flow asset when you're picking the right ones. And just lastly then, on the advantages side of this type of business model or investment model, it would be the fact that in the Dubai market specifically, you can leverage with finance. So many investors in the UK, buy-to-let investors, both student accommodation, hotel investments, care homes, and studio apartments, you typically can't use a mortgage for, unless it's a very specific specialist product, commercial product, etc., which is obviously going to have high interest rates. But one of the good things about Dubai is because the mortgage market is a lot less mature, there's a lot less restrictions around it. So here you don't actually get buy-to-let mortgages, normal mortgages, commercial mortgages. I think you do get commercial and residential. I think that's pretty much it. But you don't distinguish between buy-to-let or owner-occupier, etc. So what you can do is, go to the banks directly. Even mortgage brokers are less rare here. And they will give you a 60%, typically, if you're as a non-resident, a 60% loan to value rate. So you can be sat in the UK, you can purchase a guaranteed return option in Dubai, which is the highest tourist numbers in the world currently. And you can put down, 40% cash and get your guaranteed return. So really, really big advantage there, and what's quite unique to the market.
What and
Okay,
just on
so
that, Nick, just quickly, because with Dubai mortgages, and we won't go off on too much of a tangent because it's probably a different conversation. But what would you be able to fix in for in Dubai, sort of length of term with a mortgage? Do they have a period of time?
I'd say it depends on the provider. I'd say it's probably 3 to 5 years in most cases, but
Yeah.
it can obviously vary. So yeah, there's a number of key lenders that we know that will service non-residents particularly well, i.e., attractive terms, timeframes, interest rates, loan to value levels, etc. So I wouldn't encourage you just to go out there and just try and speak to everyone in Dubai, especially if you've got no knowledge of the market here. Speak to us. We will guide you. We'll let you know what banks to speak to. We have specialist banks that work directly on specialist products like that one I mentioned about the 8.33% return for 12 years. We've got a bank that will, work very quickly, very efficiently to offer you a mortgage product on that. So yeah, 3 to 5 years, I'd probably say approximately.
Hmm. Okay, and just lastly on that, just in terms of from a UK point of view, you can get residential stock with rental assurances, which you can leverage a mortgage still on. What you do have to bear in mind if you have that option, again, you have to make sure you're not buying a studio, which is going to be struggling for mortgages. If you're looking at 1, 2 beds and they've got rental assurances, don't think you can't get a residential mortgage on it. But then coming back to the point of making sure that the rental assurance is realistic, is because the the stress test and everything that the lender will do for the mortgage on that property will be based on the market rent, not the rental assurance. So do bear that in mind, because if you see a product offering, let's say 9% assured returns, but then when you're running the figures, it's actually coming out at maybe sort of like 2-3% gross yield. Well, a lender's not going to lend on that anyway because the market rent doesn't stack up. So just do bear that in mind. Always do your sort of due diligence to check what the market rents are, because if you're leveraging with a mortgage, that's what the lenders are going to be looking at.
Yeah, it's a great point now. I mean, what we'll do at the end of this is we'll give a few more extra tips from us as well about, what to look for, these guaranteed return options, what to keep in mind as well. But yeah, that's certainly a great starting point. Before we do go on to those tips, let's just have a quick chat, 2 or 3 disadvantages or areas of consideration, as we would say, when we're advising investors. So we touched on this one earlier, but capital growth. I mean, maybe you could speak about that a bit more as well, Toby, just because you're used to the residential market, but we do have a lot of experience in the more niche products like student accommodation, care homes. But if someone comes to you and they say, I want to get, a really, really strong capital growth rate, but I want a medium to high cash flow figure on a monthly basis, what sort of things would you be thinking about, or products would you mention in that case?
So I'll be looking at probably sort of city centre location, not maybe direct city centre. It could be outskirts city centre locations or on strong cities. I mean, if you look at the latest JLL report in terms of the current market conditions, and you look at the major cities such as your Manchester, Liverpool, Leeds, Birmingham, etc., they are still showing the forecast for the next 5 years for them to perform very well, because they're locations where demand is going to sort of do well, where there's still regeneration, but also where they're seeing good rental demand as well. So the rental yield is going to be strong and continue to grow as well. So that's where I would be saying to focus if you're looking at that. Or if that's not available, I would maybe be looking at a very close commuter belt location or town nearby to a city which is performing well, because then you'd be having an aspect of the ripple effect for capital growth, but your yields will also be strong because the prices are more favorable. So that's probably where initially I'd be looking.
Perfect. Yeah, if you're going for capital growth, and within your strategy, if you're looking at that value increase over time, I'd entirely agree. You don't really want to be going into quite specialist hotel products or student accommodation, etc. I would go more residential, city centre. Obviously, you can get those attractive mainstream yields that JLL are forecasting, but also you can look at short-term accommodation or a short-term letting model as well, where you can
Mm.
achieve similar returns to what you would get on the hotel products, but you won't have the guarantee. However, you can still get yourself a residential product and get that capital growth as well. So If that is high on your list, capital growth, yeah, exactly what Toby says. I'd go city centre or very nearby, get a lower ticket price than one of those commuter belt locations, and watch that growth hopefully over the long term. Cool. Now, this one's more Dubai specific. Just a very brief note on this one. It's the VAT charge. So a lot of agents here I've noticed coming from the UK where the standard of marketing is actually quite high and the level of, due diligence and information provided to investors is generally quite, detailed and quite transparent. Here, it's a bit more of a different sales culture. So it's slightly more aggressive, and not all of the consultants and brokers here are perhaps as transparent as they should be. And one of the ones I often see slip is the VAT charge. So in the Dubai market, when you are buying a hotel property or a commercial asset, you have to pay 5% VAT. Now, I'll get Toby's take on rental assurances and price loading in a second, but it's a similar concept. And what I mean by that is a lot of developers, they'll say, oh, look, we'll cover the VAT for you, but that's just put in the price in the first place. So you're actually paying it anyway. And other developers, they'll charge you the base ticket price for the property, and then they'll charge it, the 5% surcharge on top. But I suppose that's, what would you say about guaranteed return options in the UK, Toby, or rental assurances? I suppose the guys have to think about, what value is that if it's already included in the price? Have you seen cases of what I would call price loading in recent times, or is that sort of come out of the market now?
Yeah, no, you do still see that in a sense. You'll see it with probably off plan, sort of more sort of long time frame off plan properties
2-3 years.
where, yeah, probably 2-3 years, and where they're promising a higher rental guarantee. And that's usually probably in locations which maybe aren't as well known. So you might have a development going up. Maybe there's a 2-year, even 18-month build period. They'll inflate the rented assurance to attract investors. But then they will obviously price load, so add that into the price, which you have to be very careful of, because it can obviously the rented assurance is very attractive, but are you paying for it in the price? Usually you are, because you'll be paying prices for those type of properties in locations not as well established as you would in more established locations. So just be careful, because that's what they're doing. They're factoring in, and sometimes they're also being a little bit cheeky and maybe thinking, well, hopefully the rents will rise a bit as well, so we'll get away with it in sort of a 2-year period, and they're factoring that. And again, that's not a guarantee that the rents will rise, but they might be using that sort of from their point of view. So this is where it could be quite dangerous, because if you have a less established developer, less track record, less experience doing that because they want to sell their stock quickly. Maybe they've been advised by a company, or that's just what they're doing themselves. That's where you can run into problems once you then get the property, because once you buy the property, yes, you have the contract, the rented assurance, but if they've not done it correctly and then they go under after that period, you still have the property, which is great, but you've got a overvalued property that you've paid. So you've paid above market value, and you're not getting the rental assurance that you once thought, and that's bringing down your income as well. So just be very careful. That's why I think it's always good to look at a realistic in terms of rental assurance, which may be slightly above market value, but not too much. And then again, looking at the property values just to make sure they're not price loading too much. There will be a bit in there, but a lot of the ones we've dealt with in the past haven't actually been sort of that price loaded, and some investors don't mind that, because they don't mind paying a little bit extra for the property, because it still be market value in a sense, because you got a discount for buying off plan, and you might pay a little bit more as well. So you probably buy market value, but you've got the assurance and peace of mind of the rental guarantee.
Yeah, that's a great point. Just a couple of bits following up from that. Toby mentioned the key phrase there, market value. It doesn't matter if you are paying a slight premium if everyone else in the development is paid the same, because then that asset as a whole is valued on similar terms. So when people look to exit and resell, they're going to be doing that based on the original values they bought at. However, if 90% of the development is bought at under market value, they come along, they put on a rental guarantee, and then they put on another 5% on top. Obviously, that's when you're paying a premium and you can get impacted. Secondly, it goes back to the old saying, if it's too good to be true, it might well be. So do keep that in mind as well. these developers, they're shrewd people. They're often, quite experienced, good at structuring the numbers so they look attractive, etc. Then they use companies like ourselves to make it look attractive in brochures and things like that. But when you're looking at the underlying returns and the underlying financials and the forecast, be careful, because what Toby mentioned there is one thing that a lot of people miss. When you are analysing perhaps financial illustrations from an agent or from a developer, and they say, right, in the next 10 years, we believe you're going to make this much, have a look at the forecasts of the rental value rises and the property value rises in general, and decide for yourself, is this based on a fair market value rise on the rental side? Is it in line with Zoopla forecasts? Does this make sense based on CBRE forecasts for the property values or JLL, etc.? So really dive deeper, look at the illustrations, go into them, and then look at those sources as well, and just make sure they're all on point. Cool. Just the last one to finish off in terms of disadvantages or areas of consideration before we finish off with a few quick tips. It is reliance on the developer. Okay, so if you are buying a hotel, let's just quickly focus in on Dubai hotels. If you are buying a hotel asset from a developer here, there's no doubt about it. You do have a degree of less control over the asset. You buy a residential property within reason, as long as you're going by the regulations in this marketplace, you can decide, who's renting it, how long they're renting it for, and you can, decide the frequency on payments and the rental values, again, as long as it's in line with the regulations. So when you're buying a hotel property, it's fundamentally the success of that development, the success of that hotel is in the hands of the operator and the developer. So it's down to them, are they going to look at it? Are they going to get loads of online positive reviews to sustain those occupancy rates? When you're analysing the hotel investments, it's very important to look at the success of the project. Look at it like you're going into business with the property manager. Do I believe in them? Do I believe in the long-term success of this project? What a lot of investors will do, particularly here, is they'll say, what's the square foot size and what's the view? It's largely irrelevant. As long as it's not, disastrous or, abnormal based on the development, then it's largely irrelevant. It's more about, is the hotel as a whole going to generate income? Because that's what's going to sustain, one, your return, and two, the value in your hotel asset, which, by the way, we do see quite decent growth on hotel assets in Dubai. So, these things are important to take into account. But that's just the last point there, the reliance on the developer. And we'll finish off now and just reel through these quick 5 tips, what we think you should look at when you're analysing deals. I'll let you to cover the first one, Toby, but it is yield hunting. If people are just looking for a rental yield, what quick, couple of sentences would you give on that?
Going back to what I said a moment ago, don't be drawn in like a moth to a flame for really high yields just because it looks really, really attractive. Just make sure you're being realistic. The higher the yield, I would be questioning it as an investment. So definitely don't just chase the higher yields just because they look more attractive. It has to stack up and make sure that the developer's going to deliver. In terms of looking as well, it's got to suit your strategy. Obviously, you don't want to be taking yields which are slightly under what you're looking for as well. So, and just have to factor in, if you're going yield hunting, it could potentially impact the capital growth sort of side of things as well. So if you're looking for aggressive capital growth, you just might have to sort of accept the fact that you're going to take a hit on that if you want the yield moreover. And this is why we're always very hot on making investors to give us a real indication of what their main preference is. Is it growth or is it yield? Of course, we want both, but which would you prefer at this moment in time, so we can have more of a focus on that, because usually one will have to give.
It's funny how they never say one though, right? They normally just say both, but best of both.
Yeah,
So, that would be nice, wouldn't it?
They will always say that, but I always then sort of repeat the question, and you will get that, you will get the answer, and it is good. And we're not doing that for sort of any trickery or to get some inside information which is going to benefit us. It's really one to make them think and get them to understand what they're looking for, because on the outside, of course, they want both, and they might think they want maybe sort of of capital growth more, but when you sort of drill down and go through it and you look at their investment plans, what are they looking at over the sort of medium to long terms? If they haven't thought of it in sort of a real sort of intrinsic way, sometimes it can actually come out the other side of what they actually thought. I've had people that say they want growth, and when I really focus on their strategy, what they're looking to do, what they're really looking to build on in the next 5 to 10 years, sometimes it transpires that at this moment in time, actually capital growth might be the best option for them. But yeah, that's just why we asked that question, and we're quite sort of bullish on getting an answer out for it.
Good stuff. Yeah. So a couple of words there from Toby about sort of the strategy, yield hunting, capital growth versus yield, and thinking about maybe the bigger picture of the long term as well. Looking at more specific stuff based on hotel investments. So obviously we've got to make sure that the project and the developer themselves are well funded. So if you're looking at a project and it's 4 years from completion, it's their first project in the country, there's no track record of previous, experience of the management company, etc. Obviously, this is going to be a high risk development. But if you've got a project which is nearly complete, they've sold out 90% of the development, they've got other hotels which are operational. Obviously, this gives you an indication that one, the developer's probably half decent because they've got to that stage, which is an achievement in itself. And two, they're probably well funded because they've done quite a significant volume of sales. They might not have access to all that capital, but they'll certainly have more than they would, 2 years prior to completion. So yeah, just double check that the companies you're entering into your contracts with are decent, large, well-established firms. Moving on to the next one, as Toby said earlier, we don't want to be going too much about the return on investment or the yield. You've got to know that if you're going into this type of asset, if you're going into a commercial hotel investment, it is more of an income generating asset. And what else can we touch on? Terms and conditions. So like in the UK, where you would buy a property and go through that conveyancing or the sales progression process, you're obviously going to have a solicitor on your side that will go through or conveyancer that will read all the contract terms and make sure you understand them, and two, that they're fair. In Dubai, that actually doesn't exist. Okay, so you will get your formal agreement, and it's down to you to actively either appoint a solicitor, ideally that knows the local market, but 99% of the market will get their what they call SPA, which is a sales and purchase agreement. They'll read it, sign it, and turn it back. That really goes to show the difference. When people say the UK is a mature, robust, safe, transparent market, that's a prime example. It does have a very detailed purchase process where they try to tick off as many boxes and protect buyers. In Dubai, you get your agreement and you either sign and return it or you don't. It really, really is that simple. So when you're going into hotel investments, make sure running costs, maintenance costs, service charges, fluctuations in the return, natural disasters, payment frequency, all these little things have got to be listed and written down in black and white on your sales and purchase agreement. And just lastly, to finish off on these, it's the financial and business model of the hotel itself. So as I touched on earlier, it's so common for investors to analyze a hotel investment like they would a residential property. What's the position? What's the view? What's the size? Oh, it's not big enough for me. If I was going to live there, I would need much more space. Well, it's a hotel for a start. So you've got to analyze, is this somewhere where people are going to go on holiday? Are they going to spend a couple of nights there for a business meeting? That's the kind of thing that we're going to be analyzing. Is it going to get demand from that target market? And once you've established that, is the brand going to be good? Is their reputation going to be, positive in the long term? Is it somewhere where people are going to want to return to? So all of these factors are what I would be taking into account. So just to recap then, just to summarize my final thoughts, Dubai is an amazing opportunity to purchase hotel assets. In the quarter one of this year, Dubai had the highest hotel occupancy rates in the world at 82%. It's consistently winning awards from the likes of TripAdvisor, etc., due to city breaks being the most popular destination. Like the visitor and tourist numbers here are absolutely huge. So it really is a good opportunity to buy hotel investments which are safe, which are in high demand from well-established developers, which is not something we've always seen in the UK. Buying a dodgy hotel in Liverpool or something, a hotel unit in Liverpool is not the same, believe me. So that's what a couple of things we would be thinking about today, but that's a lot from my side. Any other bits that you'd like to add or last pointers, Toby?
No, I think that's covered it off really well. There's a lot to think about when looking at this type of investment, and depending which asset avenue you go down, hotel in Dubai or purpose-built student accommodation in the UK, etc. So, what I would say is, if it's something you are considering, just reach out and speak to us. We can go over the pros and cons, sort of delve a bit into it, something that is going to suit you. Because on the face of things, a lot of people will be attracted and think something they want, but you do have to look at the bigger picture and your plans as well. So do always take the time and care to go over that, either yourself or with a company such as ourselves, to really make sure that it is the right investment and asset for you, because obviously you're investing a lot of money, so you want to make sure you're doing it correctly. But that's the only thing I'll touch on. So I think yeah, you've covered everything off pretty well, Nick.
Cool, good stuff. So yeah, reach out, guys. We, as Toby said, we're unbiased. We work we work across both markets geographically. We work across different asset classes within those markets. We work with different developers within those types of properties. So we're quite diverse. And at the end of the day, we just want to do a good job for our investors. So we get paid, and you refer your friends, and so you get a good, medium to long term property investment. It's as simple as that. So yeah, thanks everyone for listening today.
Yeah, we'll see you next time. Bye bye.
Bye bye.
Hold on 2 secs. Did I get a picture of that? Get out of the way. That was all right, wasn't it, mate?
Yeah, it's good, mate. A little bit waffly, but
No, it was
job.
yeah, I was gonna say it was quite concise. It's decent. Nice little setup there. I got. Oh, actually, I didn't even fucking hit oh, I have to edit that out.
I thought you did it on purpose, so it kept the image up.